All right, thank you so much for putting this paper on the program. This is joint work with Tim Landvoigt and Stijn van Nieuwerburgh. You all know that they're both very good skiers, so I'm particularly sad to not have them here keeping us company, but I'll do the talk in their stead. So the motivation for this paper is kind of ripped from the headlines in a sense, right? We all know that government debt in the US is at its highest level since World War II. The CBO, Congressional Budget Office, projects that it's going to go up to more than 150% in 30 years. And this kind of leads to some stark questions for us to ask, right? Can we actually reach that level of debt and avoid default? Or kind of to put it differently and maybe more optimistically, how long can we delay fiscal adjustment? How long can we kick the can down the road before we're going to need to start raising surpluses somehow? And the common approach to fiscal policy in kind of the quantitative macro literature is not really well suited to tackling this question because the literature usually models fiscal policy through local debt stabilization. When a shock hits the economy that causes a rise in debt, government responds through kind of taxes or spending immediately, locally, and linearly to raise the surplus. And it works really nice in theory. It's very compatible with perturbation methods, but it's not really realistic. Right? It's not really realistic politically, and it's counterfactual. In fact, if you look at the data, this just doesn't happen at all. Increases in debt are not followed by increases in taxes or cuts in spending. So what we're going to do in this paper is we're going to kind of deal with this empirical pattern seriously, and we are going to model fiscal policy such that it is not responsive to debt to GDP for a wide range of values. But at some point, it must respond. The response needs to begin. And we're going to introduce kind of that point at which that needs to happen. We're going to call that the austerity threshold. In other words, it's going to be the highest possible level of debt to GDP above which the government must pursue a policy to raise surplus in order to avoid default. Now, this austerity threshold is obviously going to be an endogenous object that's going to depend on a lot of things about the economy that we're going to model. We're going to determine this threshold in a quantitative model with nominal frictions, intermediaries, and realistic asset pricing. It's going to be a pretty rich model, but we think that this is kind of still the minimal set of features we need to kind of quantitatively study this question. We're going to have a fiscal rule with global regimes and a large kind of inaction region in the middle where debt to GDP will not affect fiscal policy. We're going to have a financial intermediation sector which is going to generate endogenous convenience yields, and convenience yields are going to be a source of fiscal capacity because they make refinancing the debt cheaper. We're also going to have the model is going to deliver low interest rates, and that's going to be a source of fiscal capacity as well. That's going to come from a precautionary savings motive that you get with kind of a model that has reasonable priced aggregate risk. And what all that kind of leads to is that the fiscal policy that we're going to study will need to keep debt safe, even though the claims to kind of taxes and the claims to spending are risky. So policy will going to need to insure debt holders somehow. Once we kind of put together the model, we're then going to answer a question or ask the question: which policies create the highest austerity threshold? Which policies create the most fiscal capacity? And that's going to depend on whether you pursue in austerity tax increases or spending cuts. Kind of two ways to raise a surplus. We're going to find that if the surpluses are raised through tax-based austerity, the threshold is about 190% of GDP. With spending austerity, it's similar, a little bit higher at 200%. But even though these kind of two numbers are similar, the way policy works in austerity, whether it's taxes or spending cuts, is going to be quite different. Taxes are going to resemble negative supply shocks. As a result, because folks don't want to work as hard if more income is being taken by the tax man. So as a result, these negative supply shocks are inflationary, so monetary policy needs to fight inflation. In contrast, spending cuts resemble more negative demand shocks. And monetary policy kind of can stabilize against negative demand shocks fairly effectively for kind of standard divine coincidence type reasons. We're going to study which parameters, so things that are kind of, we don't think policy can change, things kind of immutable characteristics of agents, and also which policies can expand the threshold. So first, kind of to understand the model mechanisms, we'll show that higher risk aversion or lower labor supply elasticity can both be sources of fiscal capacity in that they push that threshold up. On kind of the policy side, things that the government can actually control, it's shorter debt maturity, a form of financial repression, where short-term debt is effectively required to be held by financial intermediaries, and interestingly, hawkish monetary policy and austerity. Now notice that kind of goes against a lot of kind of what we think about how monetary policy can accommodate the fiscal authority, where we think at high debt levels, maybe the monetary authority needs to be a more accommodationist, needs to keep rates low. Well, we actually find it's the opposite, that committing to a hawkish policy can create fiscal capacity, and I'll explain why. Now, it's important to kind of stress here, right, that when I talk about things that increase fiscal capacity, I'm not necessarily saying that's a good thing. Right? Fiscal capacity does not necessarily mean welfare. More government debt for longer could lead to crowding out of the private sector. And in fact, in some of the counterfactuals I'll show you, that will indeed happen. But the government and a lot of us are kind of concerned about what the fiscal capacity is and what kind of defines it. So we're going to study that as a primary object, even though kind of keep in mind that if I say that something increases fiscal capacity, that's not a normative statement. And finally, our kind of most sobering result, I'd say, is to consider the role of fiscal uncertainty. The two experiments I showed you above with 190 and 200%, those are for environments where everybody knows that once we cross the austerity threshold, there will be tax increases. Or in the other kind of, there will be spending cuts. Everyone knows which policy will be pursued for sure. But if we don't know, if there's uncertainty about which kind of policy will be pursued, the austerity threshold falls to 127% of GDP, right? Considerably lower, and much closer to the debt levels now. And this happens because these regime switches in austerity, the type of policy that you pursue, cause large bond valuation swings, and that could make kind of the market value of debt too high. So let me jump into the model, and let me kind of begin by showing you a rough kind of overview. The model is going to have a couple of types of households. It's going to have hand-to-mouth households and savers. Savers are going to ultimately own all the assets in the economy, be that kind of the non-financial firms that produce with a kind of standard New Keynesian production block, or financial intermediaries. Financial intermediaries are going to supply the production with capital. They're going to issue deposits to households. Households are going to value those deposits. Households also own the intermediaries. And kind of most importantly for this paper, right, there's going to be a government sector which is going to back its debt issuance with NPV of taxes. And there's going to be two kinds of debt, short and long term. Short is going to be held by intermediaries. Think of that as kind of resembling reserves, right, or T-bills. And long-term debt is going to be held by households. I'm going to briefly talk about the private sector side of the economy because it's fairly standard, and then I'll spend kind of more time on the new stuff, which is the government. So productivity here is going to be stochastic. It's going to consist of mean reverting and permanent components, so transitory and permanent. And it's going to follow a discrete Markov chain. We're going to have, again, two kinds of households. Savers are going to have recursive preferences over consumption and bank deposits. They're also going to get utility from government spending. That doesn't really affect anything, but it allows us to make some kind of welfare calculations. Just so you know, spending cuts aren't free. And they're going to dislike supplying labor, of course. Hand-to-mouth households are going to have no intertemporal problem at all. They're just going to choose labor supply, get a wage for that, and they're going to consume that labor income as well as transfer income that they get from the government. Financial intermediaries, like kind of the balance sheet slide said, they're going to be a firm owned by households, and they're going to make portfolio choices subject to a capital requirement, and perhaps kind of more interestingly for this paper, right, a liquidity coverage cost that we're going to think of as kind of in a flexible, continuous way, capturing regulations like liquidity coverage ratio. In other words, this cost is going to be increasing in the amount of deposits and decreasing in the amount of short-term debt. So buying more short-term debt allows the bank to decrease that cost. And in that sense, it's going to lead to kind of a path-through from deposit convenience yields into convenience yields and short-term government debt. Moving on to the government, that's kind of where most of the action is, right? Monetary policy is going to be fairly standard. The monetary authority is going to follow a Taylor rule. The one kind of wrinkle in this paper is we actually have an asset that pays the interest rate that the policymaker sets. It's going to be the short-term debt that banks are going to hold. Of course, that's the asset that whose rate is set directly. Other interest rates in the model are endogenous, and there's going to be imperfect pass-through to deposit rates and long-term bond prices. Those are going to respond in equilibrium. On the fiscal side, right, the government is going to make kind of taxes and spending decisions, and debt issuances, and the thing that ties all of those together is the government budget constraint. So the constraint says that the real market value of debt, whether it's short-term debt or long-term debt, coupon and ex-coupon value, needs to be backed by either primary surpluses in that period or new debt issuance. And we're going to assume that that new issuance happens in fixed proportions over time. The primary surplus is going to, of course, consist of taxes less spending. Taxes are going to be labor taxes on the two types of households, profit taxes on the two kinds of firms, intermediaries and non-financial firms, less government consumption, think of national defense, road building, and less transfers to both types of households. Think Social Security, Medicare, or Medicaid. The policy is going to follow kind of pre-specified exogenous rules that are motivated by two objectives. The first objective is kind of standard, that's macroeconomic stabilization. So spending is going to be counter-cyclical, taxes are going to be pro-cyclical. Right? Taxes are higher in good time, spending is higher in bad times. But there's going to be a second motive. Right? If we only had this first motive, if there's only macroeconomic stabilization, debt cannot be safe. The thing that makes debt safe is the second motive, which is debt stabilization. That surpluses will be adjusted when debt to GDP becomes very low or very high. All right, maybe the slide will click. There we go. So there's going to be two exogenous components to fiscal policy. There's going to be transfer spending shocks. Think about this capturing kind of things like slow-moving effects like demographics, kind of growth of the welfare state, really kind of persistent shocks. And also we're going to have these austerity regimes which specify whether once the threshold is reached, once surpluses start being raised, whether that's going to happen through tax hikes or spending cuts. For most of the talk, I'm going to focus on special cases where it's going to be one or the other with certainty, but at the end we're going to actually introduce some uncertainty about that process. So to show you how debt stabilization actually works, let me show you these fiscal rules that are a function of debt to GDP. See that debt to GDP is in the x-axis. We're going to have kind of taxes and spending as a fraction of their kind of interior region values. And the interior region here is going to be specified as the space between these two thresholds over here. The lower threshold and the upper threshold, which is the main thing we're interested in, the austerity threshold. So in the first regime, a regime where stabilization happens through taxes, you'll see that, first of all, in the middle, both taxes and spending are not responsive to debt to GDP. That's the inaction region. When debt to GDP is really low, there are tax cuts. When debt to GDP is really high, there are tax increases. Spending is unchanged, taxes go up, and they go up kind of in this increasing convex way, parameterized by this parameter tau. That's one of the parameters we're going to play around with. That's the first regime. In the second regime, what changes is how austerity is pursued. So in the second regime, or regime 0 here, it's taxes that are kept constant, but it's spending now that's decreasing, and kind of decreasing at an increasing rate, parameterized by gamma. So these are kind of the two types of austerity policies. Finally, to kind of close the model, there's a new Keynesian block that's fairly standard. We use a standard equilibrium concept. It's competitive equilibrium. And the thing that I want to talk a little bit about is solving this model, because it's not an easy model to solve. We have 4 exogenous state variables, 4 endogenous state variables, and the model needs to be solved globally. There's occasionally binding constraints. The global tax and spending rule kind of necessarily implies a global solution. And the fact that there's kind of large risk premium also mean that centering these rules, making sure that taxes or both the kind of macroeconomic stabilization policies, monetary policies respond to deviations from some kind of steady state, requires the correct notion of stochastic steady state. So solving this model is a bit challenging. The model is quantitative, of course. There's a really long calibration section in the paper, because I think one of our main contributions is quantitative. I invite you to take a look at that if calibration is your thing, but I'm just going to highlight a couple of things here. So we're going to calibrate transfers, the transfer process based on levels of transfer spending in the data as a fraction of GDP before 1990 and after, kind of separating this increase in transfers into these two kind of discrete states. the model is going to deliver an output risk premium, and the reason it's going to do that is through Epstein's preferences and, of course, the stochastic growth process. It's important, of course, in a paper about fiscal sustainability to have the right term spread. The way that we're going to do this is first through convenience yield and short-term debt, but also kind of the model tells us very strongly that to get an upward sloping term structure, you need positive correlation between permanent and transitory shocks. And in fact, for parsimony, we just set that correlation to 1. On the government side, we're going to have 2/3 of government debt being long-term. That's consistent with the data. And that long-term debt, how long-term is it? About 8-year duration on average. And then we're going to, for the fiscal policies, for the part that responds to macroeconomic conditions, we're going to kind of look carefully at different types of taxes, different types of spending, and how the growth rate and those things respond to growth rates in GDP. And we're going to calibrate those cyclicalities in some detail. The most important parameter, though, and of course, the one whose calibration you're most interested in, is the austerity threshold itself. The way we're going to set it, to kind of describe it intuitively, is such that debt to GDP doesn't get to what I'll call an unrecoverable value. Now, what does that mean? Well, consider a policy that increases taxes. Right? Every additional increase in taxes raises less and less tax revenue for standard kind of Laffer curve reasons. Right? There's a labor distortion. So that means that at some point, there's a maximum amount of surplus you could raise through taxes. The maximum amount of surplus then implies a maximum repayable debt to GDP. Because if you're at a level of a debt to GDP where interest expenses increase the maximum amount of surplus, primary surplus you can raise, well, that debt just stops being repayable. Now, I kind of explained these two concepts in a very simple deterministic way. Of course, in a model, they're all going to depend on state variables. They're going to depend on shocks. So this intuition kind of has to be implemented stochastically. And the way we're going to do this is through simulation. We're going to set that threshold such that that level is reached in only 1 out of 50,000 simulations. Why 1 out of 50,000? Why not 0? Well, if it was 0, we could always increase the threshold a little bit more. So we increase it until just kind of one path is the one that fails. What do we get? I want to first talk about the case with tax austerity. That is where stabilization is pursued through tax hikes. I'll talk about spending austerity later. And I'm going to do this through a series of plots, which are going to, kind of on the x-axis, plot debt to GDP. On the left y-axis is going to be just a probability density. That's kind of the same repeated histogram in all these plots. And on the right y-axis is going to be conditional means of various kind of equilibrium quantities of interest. The first thing that I just want to point out here is that if you look at the histogram, this does not look like something that you could well approximate using perturbation methods. Right? This is not a nice unimodal distribution with a peak around some kind of steady state. So global solutions are necessary here to kind of understand what's going on in these austerity regions. To see kind of exactly what's happening, right, I plotted these two thresholds. Focus on the upper one, it's a little bit below 2. That's 189% of debt to GDP. Above that level, you could see taxes rise sharply. That's the bottom left panel. So tax adjustments kind of keeps going up. Why does it have to start there? Why can't it start later? Well, if you start later, you are not going to raise surpluses fast enough to stay under kind of this maximum repayable level of debt, so debt would not be safe. How do you get into austerity in the first place? Right? How does this occur? Well, the top two panels show the conditional means of exogenous shocks. And what they show you is that to get to austerity, you need low growth and high transfer spending. So kind of consistent with maybe what we've observed kind of in the data in terms of where we're headed. Once you're in austerity, what happens there? Well, the top right panel shows you that output declines substantially. Right? As these taxes are going up, they look like a negative supply shock. Workers are working less, output is shrinking. Moving on to kind of asset prices to see what this does on the financial side of the economy. The fact that this looks like a negative supply shock means that, top left panel, inflation is going up in austerity. And because inflation is going up, the central bank responds to that by increasing interest rates. Convenience yields, of course, also decline because there's just more government debt. That's a standard feature of kind of the data as documented by previous papers, and kind of in our model achieves that as well. At first, this decrease in convenience yields lowers term spread. But then, as you get close to the austerity thresholds, term spreads go up. And the reason that happens, bottom right, is because term premium is increasing. Why is the term premium increasing? Well, remember, this austerity looks like a negative supply shock. So inflation is bad news. Inflation is bad news. You get high inflation risk premia, high term premium. Output risk premium is kind of on the bottom right. That one continues kind of decreasing, largely driven by convenience yields. So what that tells us is that, as other presenters have noticed, this keyboard is a little funky. So what that tells us is that you see opposite patterns in the term premium and the equity premium as you get closer to austerity. And that's going to be kind of interesting because we'll see a different pattern in spending austerity. And that's maybe something that we could look at in the data to see what kind of things we should expect. One thing that you could look at next is kind of where does government debt safety come from? And to do that, you could decompose the value of debt to GDP, of government debt into a claim to tax revenues minus a claim to spending. And obviously, as kind of, if you plot debt to GDP on the x-axis, right, as debt to GDP increases, just kind of mechanically, the sum of those two claims needs to become more and more positive, right? It needs to kind of increase with debt to GDP. What this shows you is that the way that this happens is that the value of the claim to all future tax revenues is the one that's rising. Even though taxes aren't going up, because austerity is becoming more likely at higher debt levels, the value of the tax claim is increasing then because there will be more tax revenues in austerity. Once you net those things out, you get to the yellow line. It's not quite the 45-degree line. The difference between those is convenience yields. So the other source of kind of debt safety is the convenience itself. Moving forward, you could also take a look at kind of the second moments and see how does macroeconomic stabilization, how is it compatible with debt stabilization, right? On one hand, we know that the government needs to insure taxpayers, but it also needs to somehow insure bondholders to keep debt safe. And the way you could see this is you could regress the growth rates in spending and taxes, kind of the fiscal claims, on growth rate and output. And as I mentioned, taxes are pro-cyclical, spending is counter-cyclical. So if you look at short horizon regressions kind of 1 quarter ahead, 2 quarters ahead, you see indeed that these betas are above 1 for taxes, below 1 for spending. Taxpayers are being insured. So how can that still be compatible with safe debt? Well, the reason it's compatible is because once you leave normal times and you enter austerity, the cyclicality of taxes changes dramatically. And taxes now become very counter-cyclical, and and as a result, you achieve debt stabilization. So normal times, taxpayers get insured. Austerity times, bondholders get insured. Moving on to spending austerity. So same types of plot, but now the stabilization is going to be pursued through spending. You can see this middle panel on the bottom here. Austerity kicks in a little bit later at 200% of debt to GDP. The way you get there is the same. You still have low growth and high transfers that push you into austerity. But now if you look at the output panel, top left, top right, you see that output is actually increasing in austerity by a little bit. Right? So these negative output effects kind of have gone away. Moving on to prices, you see why kind of that's the case. A cut in government spending looks like a negative demand shock. Right? Government is demanding less resources. There's lower government consumption. Inflation drops. That's something that is fairly easy for the monetary authority to respond to. It cuts interest rates. As a result, the term spread is now strongly declining. And the reason why that's happening is, again, if you look at the term spread, it's the term premium. It's a term premium that's now really declining. And why is that? Well, now austerity is pursued through demand shocks. If you think about kind of Caroline Pfluger's work, right, there's a very natural connection between the dominance of supply versus demand shocks and the sign of the inflation risk premium. So with negative demand shocks, or with demand shock type austerity, you see a decline in term premium. Equity patterns still look the same, and what that tells us is that there's a type of austerity that is pursued is going to affect asset prices even when you're not yet in austerity, even as you're approaching austerity. And that means that we can potentially look at asset markets and their dynamics to infer something about market participants' expectations about what will happen once the threshold is going to be reached. If you do that decomposition that I showed you earlier for spending, now kind of looks like a mirror image. It's now the value that's claimed to spending that decreases. And if you look at the cyclicality of tax and spending kind of at these betas, you now see that, again, taxes are pro-cyclical, spending is counter-cyclical. But once you get into austerity, spending becomes pro-cyclical. And again, that's the source of stabilization. The last couple of things that I want to talk about is I want to show you kind of what affects the austerity threshold. How does it respond to kind of various features of the model or policies that a government can pursue? To do that, I'm going to first kind of show you in the first column the baseline economy. With the tax economy, we have a similar table in the paper for spending austerity. You can take a look at that at your time. The bound is going to be that 190%. What type of policies can we consider? Or what type of kind of changes to the model can we consider to see the sources of fiscal capacity? The first column, labeled LS, is going to be an economy with more elastic labor supply. If households respond much more strongly to changes in tax rates, so cut back labor less, that of course lowers fiscal capacity. You see the bound drops to 150%. An even bigger response happens if you lower risk aversion. Right? Risk aversion is a source of low rates through the precautionary savings motive. With a lower risk aversion, you end up with higher interest rates, a lower capital stock, of course, because there's less things being saved, and a much lower bound. Now, these are just preference parameters. They're not something that policymakers can control. Let's talk about things that policymakers can control. We can increase the share of short-term debt from 1/3 to 1/2. That through kind of an upward sloping term structure that moves more debt into the short term. Now, of course, that introduces kind of some more volatility in the interest expense, but on net, it actually ends up increasing fiscal capacity. But what it also does is it increases the debt to GDP level on average, and that's going to crowd out capital. So again, as I said earlier, what's good for kind of what increases fiscal capacity is not necessarily good for welfare. A similar result can be attained through financial repression. If you just tell banks through this kind of liquidity cost that they have to hold more short-term debt, that's going to also push up the bound. But again, it's going to push up the debt level and also lead to crowding out. The one policy that expands fiscal capacity but actually lowers the average level of debt and crowds capital in is a promise to pursue hawkish monetary policy in austerity. So the way we're going to model this is a 30 basis point higher interest rate than the Taylor rule would otherwise suggest once you're in austerity. Now, the way that works, right, the promise to pursue this is going to lower inflation expectations as you get closer to austerity. With lower inflation expectations, yields are lower. The cost of capital for the government is lower as a result. So not only is the bound higher, but the average level of debt to GDP is lower because it becomes cheaper to finance. And that crowds capital in, and that's actually welfare increasing. The last couple of policies play around with the parameter that's the hardest parameter to calibrate in this model, and that's the speed of tax adjustments in austerity. We haven't been in austerity yet. We don't know how fast it's going to happen. So we can take kind of from the baseline value, we could try a number that's a little bit lower, try a number that's a little bit higher. You see that kind of quite naturally, if you adjust taxes more gradually, you have to start earlier. If you're going to adjust taxes much steeper, you can afford to start later. But whether you start earlier or later, the welfare effects in both cases are actually a bit negative. So that's kind of suggests that the number that we pick, and that's kind of how we went about picking it, is something that's close to optimal. The final thing that I want to show you is the effect of uncertainty about which type of austerity will be pursued. Everything we've said so far has been about guaranteed taxes or guaranteed spending austerity. In reality, we don't know how it's going to happen. So what we're going to do is we're going to take this process. We're going to kind of allow it to take either value, spending or taxes. We're going to calibrate its persistence to the persistence of the US political cycle. And we have to commit to some kind of unconditional probability. Let's look at the case of 0.5. It's kind of the most agnostic one. In that case, the threshold drops from 190% in the tax case to less than 130%. And to see why that happens, it's useful to study kind of the impulse responses to a change in policy. Think of this as an election where a new party comes in and they're going to pursue they're going to switch from taxes austerity to spending austerity. So that's kind of the top panel, shows you the probability of tax austerity, right? It drops from 1 to 0. And you see what happens is that that's really deflationary. And because it's very deflationary, the real value of debt to GDP goes up. And that's how you can end up in the unrecoverable region. It can increase debt GDP by a lot. To prevent that from happening, austerity has to start earlier. I'm out of time, so let me just conclude. Fiscal expansion raises questions about debt repayment, right? At which level the government must raise surpluses to avoid default. We show that the answer depends on the type of policy used to raise the surplus and the expectations about the regime that's pursued in austerity, which of these policies are going to be, has effects on asset prices away from the threshold, suggesting possibly some kind of empirical implementation of what we've done. Finally, kind of the most stark, sobering result that I want to leave you with, right? Don't remember the 190% number. Don't remember the 200% number. We don't know a particular austerity policy for certain. With uncertainty, the threshold is 130%, and the CBO suggests that's likely to be breached in the next 10 years. Thank you so much. I look forward to the discussion.